Welcome to DayTradeToWin.com. Alright, so in last week's episode on how to day trade using price action, you gained an understanding about how the pricing of securities worked through my simplified and silly examples. We also had a look at the big green candle, and you learned what it really means when you see one of those big green candles in your chart. I believe it's important for you to understand the mechanics behind the candles in your chart. Usually the big green candles are found in strong uptrends and they signal a continuation of the trend. I didn't go through the big red candles, but I know you're pretty smart, so you probably already figured out that the big red candles are the opposite of big green candles. In other words, the big red candles are big bearish candles found in a downtrend. They can also be found right at levels of support when big, strong moves are required for a breakout. Same thing with a big green candle. They are often found at levels of resistance, and the big green candle represents the strong demand that is needed to break through the resistance. These are also continuation candles, meaning that they indicate a continuation of the trend. In an uptrend, you want to see bullish candles, and in a bearish trend, you want to see bearish candles. Makes sense, right? There are also reversal candles that signal a reversal of the trend. Today, I will go through a basic reversal candlestick pattern. This is simply called the reversal candle. I will go through examples in an uptrend, and there are 4 main variations of this pattern. This pattern is always formed over 2 candles, but that doesn't mean that you're only going to look for these 2 candles. You'll also need to take the candles before that into consideration. Always when you trade patterns and trade price action in general, you cannot just isolate a few candles and only look at those few candles. It's just like when you're reading a book, you cannot just read a word here and a word there. You need to read and understand the whole sequence of words in order to get anything meaningful out of it. So when you're reading price action, you'll need to consider the whole chart. Has the stock been in an uptrend or a downtrend? Is it moving sideways? Is it erratic and chopping around? And so on. So the definition of a reversal candle is that the candle opens, it makes a high but then closes below the open. And that also means that it closes below the close of the previous candle. There are also variations of this pattern. The first variation is the outside reversal candle. Outside means that the highest high of the candle is higher than the previous candle's highest high. Then we have the key reversal, which means that the candle opens lower than the previous candle's close. It then moves higher and then closes below the open, and it also closes below the previous candle's close. And then finally we have the outside key reversal. The candle opens lower than the previous close. It makes a new highest high, higher than the previous candle's high, and then closes below the open and below the previous candle's close at the same time. The same principles apply in downtrends, but you'll need to replace the highs and lows with the lows and highs, right? So an outside key reversal in a downtrend opens higher than the previous close, it moves lower than the previous candle's low, it then moves back up again, closes above the open, and thereby also closes above the previous candle's close. Like I mentioned in another episode in this price action day trading series, the market always tests where it has been before, so the outside key reversal is a final test of that price level, of that previous high or low, just before the market starts heading in the opposite direction. It's a good candlestick pattern. Alright, and remember, you cannot just look at these 2 candles of the pattern to be successful with this. If you have sideways, erratic, choppy price action, it doesn't make any sense looking for the reversal patterns. The market needs to be in a trend, it needs to have predictable swings higher and higher, 2-3 swings that you can clearly see. Then, as we approach a potential top of a swing, the price action starts to arch over, you can start looking for reversal patterns. Then you're likely to catch the top of the swing and be able to successfully trade short. Of course, if you're in a downtrend and you get the reversal patterns at the bottom of downswings, then you trade long. We'll cover more on this in the next video, so please subscribe and please like this video by clicking the thumbs up. And by the way, did you know we also offer day trading mentorship? The next 8-week mentorship program begins soon, so head over to DayTradeToWin.com to sign up now while there are still seats available. Until next time, good trading!